All right. Let's get started here. I'll start off first of all with saying, and I think all of you know, that we launched the Alternative Investing Club Fund, and it is right here. It's live at the moment. If you are interested, what this is we're looking to identify 7 to 10 key private placement strategies. These strategies, we're hoping to find investments that are non-correlated, maybe not completely non-correlated, but at least non-correlated from the overall market and as much as possible from each other. So we're looking at the first deal that's going in is with DLP Capital, and they have a real estate debt fund. Bringing them in as the first deal that we're investing in does a couple of things for the fund. It actually allows us to meet the cash flow because the cash flow from the DLP fund is 9 to 10%. So we can turn around, meet that cash flow which is 8% in the fund. And the other thing it does is it has a 90-day redemption period, which means that if people put money into the fund, we can potentially take that, sell it in order to put it into a syndication or some other investment which may not be as liquid but has a higher rate of return. The other thing that allows us to do is it allows us to have liquidity within the fund so that people can buy and sell in and out of the fund. So that's why we're making DLP our first investment, and they've been giving a distribution on a monthly basis since 2014. So if you're interested, I'll drop a link in the chat. And that is my only real announcement today. So, Brian, welcome to the group here. Can you take a moment, introduce yourself? You can talk, or we can have a little more of a dialogue, whatever you'd like.
Yeah. So my name is Brian Davis. I have been in real estate for about 21 years. I fell into it by accident. Graduating college back in 2003. No idea what I wanted to do with my life, like so many of us. And I fell into working for a hard money lender. And that was my introduction to real estate. I've been working it ever since. I am the co-founder of sparkrental.com. We've done a lot of different things over the years, but our main focus today is a co-investing club, which I'll mention briefly in the presentation, but this presentation is not about that. It's about how to find asymmetric returns, how to find passive real estate investments that pay high returns with relatively low risk. So that's what we'll be talking about today.
And Brian, I just dropped Spark Rental in the chat.
Oh, so awesome! Thank
you. People want to go visit it? Links in the chat.
I'll share my screen and we can jump into the presentation unless you guys have any questions, anything you want to go over beforehand. Before we jump right in.
No questions, I guess.
All right.
Oh, I'm still sharing my screen, aren't I? All right. Go ahead and take that.
All right. Can you guys see my screen?
Yes.
Okay. All right.
Let me also say that just for the recording, welcome to the Alternative Investing Club. Today is July 26th, 2024.
All right. You guys see my screen?
Yes.
Okay. There we go. So today we're talking about how to spot asymmetric. Oh, you know what? I'm so sorry, you guys. Let me silence my Skype. A total amateur hour here. Do not disturb. Okay. Now we're good to go. Okay. Just hide floating meeting controls. Okay. Oh. Amateur hour indeed. Okay. Asymmetric returns. How to spot high returns, low risk in passive real estate investments, because that's why we're here, right? We all want to earn high returns. We don't want to take on high risk for them. So here's the premise of this conversation today is that most syndications will promise between 15 to 20% total returns, right? IRR. Some of them come with very high risk, others come with relatively low risk. So, the premise of our conversation today is how can you spot the difference? How can you find those investments that offer the asymmetric returns, the relatively high returns with relatively low risk? So, my pledge to you guys within the next 45 minutes, you will have a new framework for quickly gauging risk for real estate syndication deals. And of course, invest small amounts passively from anywhere in the world, like I do. I'm based in Lima, Peru currently. Spent the last 9 years living overseas with my wife and daughter. And just for gits and shiggles, as they say, there are a surprising number of nerdy Lord of the Rings references here, just to keep things interesting. So here's where most people start their financial journey in life. They start as either an employee or as being self-employed. Either way, they're trading their time for money. Most of us want to be on the right-hand side of Robert Kiyosaki's cash flow quadrant here from Rich Dad Poor Dad. We want to either be business owners or investors where we no longer have to trade our time in exchange for money. And passive real estate is a great vehicle to get us there. We all want to reach the finish line, if you will, reach financial independence, at which point work becomes optional. You can cover your living expenses with your passive income from investments. You could retire at that point if you like. More likely, you just switch to work that you love if you are still young and have a lot of gas in the tank. I've interviewed dozens of people who retired early with real estate investments or with other means, and they all went back to work. Every single one of them went back to work because there's only so long you can sit on a beach sipping margaritas. Reaching financial independence, it's the one financial goal that every single person on the planet shares. We all have to retire someday, right? But it's up to you when you want to reach financial independence and or retire. So who here owns real estate investments currently? I'm guessing most of you guys. And please, jump into the chat. We really want to keep this as interactive as possible, despite it being a presentation. So yeah, raise your hand in the chat if you own real estate investments currently. I'm guessing that it's most of us here. Why do you love real estate? Why do I love real estate? There are a lot of answers to that question. One, it offers strong returns. It generates ongoing income. You also benefit from appreciation and long-term growth. It has low correlation to the stock market, so you get true diversification value from that. Comes with great inherent tax benefits, and it's inflation resistant, which is awesome, especially when we have high inflation like we've had over the last couple of years. There are some brick walls. There are some challenges if you go out and buy real estate directly. And often, even if you don't, even if you invest indirectly, it takes a lot of money to invest in real estate. It takes a lot of time to learn how to invest actively in real estate, to buy properties directly, to manage properties, manage contractors, and hassle with inspectors. It takes a lot of time to learn how to do this as well, to consistently earn high returns. So these are some of the barriers to entry with real estate investing. We all here are probably familiar with passive investing, so I'm not going to spend a ton of time on this. Some of the options for passive investing: notes, of course, funds, whether those are debt funds, equity funds, private equity, real estate syndications, which is what we're going to be mostly talking about today. And the idea here behind syndication investing, again, as you guys, I'm sure, are aware, get the benefits of real estate ownership, the cash flow, the appreciation, the tax benefits, without having to become a landlord. So these are kind of what a typical real estate syndication return curve might look like. It does form a bell curve. Some of these are going to underperform and lose money for you. So you can see on the left-hand side of this graph, there are some syndications are going to deliver negative returns. And then they form a bell curve, with the middle around the target IRR. And then some of them hit it out of the park and overperform, right? Like all investments, syndications come with very real risk. And those negative returns on the left side of the graph here, that's what we really want to avoid as passive real estate investors. And that's what we're going to be talking about today. So how do you check deals for some of the biggest risks that come at you as a passive real estate investor? So there's really two broad ways that real estate syndications blow up. One is the sponsor runs out of time. So the loan term ends, for example, and they have to refinance or sell or do some kind of capital event. Or the sponsor could die with no qualified successor. That is also a way that a sponsor could run out of time. And the end result here, sponsor is either forced to sell or refinance or do something really creative and, which may or may not be in the best interest of passive investors, regardless of whether it's a bad time to sell, a bad time to refinance, and so forth. More commonly, however, the sponsor runs out of money, usually due to negative cash flow. So something happens to the deal, it goes awry, it starts losing money month after month instead of earning money. And the result is the sponsor does a capital call. And if that is not successful, the sponsor defaults, the lender forecloses on the property, there's a fire sale. It's all bad. It's all the stuff that we want to avoid as passive investors. So our plan for today is to talk about 6 risks that you want to nix, that you want to knock out as a passive real estate investor, 6 risks to check for as you're looking at prospective real estate syndication deals. Now, this is first pass analysis, right? This is not deep due diligence analysis that takes hours and hours, which you should be doing too, by the way. But this is what we're talking about today is a back of the napkin risk analysis that you can do in 60 seconds or less to disqualify a lot of real estate syndication deals without having to waste a bunch more time on the deep due diligence. This will help you find some of the most promising syndication deals to then dig deeper into with that due diligence. So something to keep in mind, this is a first pass at qualifying these deals. This is not the end. This is not the final word on qualifying these deals, but it's really useful to weed out the bad deals instantly so you don't waste any more time on due diligence on them. And this is particularly useful because what we have found with real estate syndication deals is just like with airplanes, syndications don't crash from one thing going wrong, from one isolated failure. In the aviation industry, they talk about what's called a cascade of problems, where on average in aviation, it's usually 7 things go wrong at the same time to cause a plane crash, to send a plane down. It doesn't happen from 1 or 2 isolated things in the overwhelming majority of cases. You have this cascade of problems. So when we are looking at these syndication deals, we want to look at these most common problems, things that go wrong. And if we can eliminate or minimize the risk of those problems, then we end up with much safer footing as an LP, as a passive investor in these deals. So here's a quick nightmare case study that I will return to periodically throughout this presentation, just to illustrate some of these risks and some of these points. So this is a case study that I invested a little bit of my own money in a couple years ago. This sponsor, they borrowed short-term variable interest debt. You know where that's going. Interest rates, of course, skyrocketed at a record pace in 2022 and early 2023. The insurance premiums for these 2 properties in this portfolio, they doubled in a single year. These properties were in Florida. The property management was totally incompetent. The lead sponsor himself was super inexperienced, but he had partnered with some big name sponsors who were quite famous and well respected in the industry. So that got kind of glossed over, that even though the lead sponsor, the person who was actually managing this deal, he was very inexperienced, didn't really know what he was doing, but everyone kind of glossed over that because he had these bigger, more famous co-sponsors on the deal with him. And the lead sponsor hid the problems with this property from his partners, from his co-sponsors on the deal, until it was too late. They did a capital call. It completely failed because no one had any confidence in this deal anymore. So you can see the cascade of problems here, right? How all of these different things went wrong at the same time for this deal. And again, we'll come back to this as an example in case study. Now, there is one risk to rule them all here, and that is sponsor risk. That's not something that we're going to be digging into today. It's a separate conversation, but it's something that's just worth mentioning, that it doesn't matter how good a deal is if the sponsor themselves is untrustworthy or incompetent, as was illustrated by that case study that I just mentioned. Bad sponsors can ruin totally good deals, and likewise, good sponsors can salvage bad deals. So sponsor risk should be the first thing that you look at. Again, it's outside the scope of our conversation today, but it's worth mentioning. And this applies to partner risk as well. You want to look at who's the lead sponsor on the deal, not just who is the co-sponsor who maybe you're familiar with and maybe you trust and like, but who is the actual lead sponsor who's going to be managing this deal day to day. In that nightmare case study, the co-sponsor who I had invested with, he was not the lead sponsor on that deal. And by the time this co-sponsor booted out that primary sponsor, Deal, it was too late. Deal could not be salvaged. All right, enough backstory. Are we ready for the 6 risks? You guys ready to jump in here? And again, don't be shy with the chat, please. I want to keep this as interactive as possible. All right, the first risk that we're going over today is debt risk. It's probably not a surprise. It's probably the first one you guys were expecting. This is actually a bunch of related risks all under the same umbrella of debt. So the first type of debt risk is just the term of the debt. How long is the loan term? And remember, circling back to what we talked about before, running out of time is one of those big umbrella risks that sinks syndication deals. Prepayment penalties are also a type of debt risk. Is there a prepayment penalty in the financing for this deal? Is there some other fee for paying off the loan early? How much is it? When does it phase out or disappear? Did the sponsor price that into their return projections and their pro forma? Another risk, of course, is interest. Is it fixed rate? Is it floating? Variable interest is not necessarily a deal breaker. I feel like some passive investors maybe learned the wrong lesson over the last couple of years, where some passive investors won't touch any deal that has variable interest debt. Variable interest is often way cheaper than fixed interest debt. However, the sponsor needs some kind of protection in place against rising interest rates. It could be a rate cap or a rate swap or some other structure, but there needs to be some protection in place against runaway interest rates like we saw in 2022. What is the LTV, the loan to value ratio? That is another type of debt risk. The lower the LTV, the safer it is for us as passive investors. But that also eats into the potential returns on the deal as you're looking at less leverage. On balance, lower LTV is probably a better thing for you as an LP. For us, it helps protect us some. Now, here's the opposite case study. Here's a dream case study. This was another deal that I invested in. I guess this was last year. It's a portfolio of 2 select service hotels outside of Fort Knox. The clientele was mostly government workers, government contractors, and the sponsor assumed a loan with fixed 5.1% interest, 9 years remaining on the loan term. And these hotels cash flowed well from day one and have been paying distributions ever since. So you don't need a crystal ball to know that the debt risk on this deal is pretty low, right? I mean, I couldn't tell you what the hotel market for selling is going to look like over the next 2 years, 3 years, 5 years, whatever. But at some point between now and 9 years from now, there will be a good moment for exiting these hotels, right? So you've got plenty of runway here for to reach a good seller's market for these hotels. All right. Number 2, property management risk. Who's going to manage the property day to day? How many properties has this property management team managed for this sponsor before? How many deals have they worked on together before? How many years have they worked together? If it's the first time that they're working together, that's higher risk. If it's their 10th time, 15th time, 20th time, that's great. That's awesome. Use your judgment here, but the more experience that the sponsor and the property management team have working together is lower risk for us as passive real estate investors. Now, what doesn't matter here is whether the property management is in-house or hired out, as long as they have a long history working with the sponsor. When a deal goes bad, when it gets into trouble, it usually involves bad property management. So you end up with low occupancy rates, you end up with weak marketing, unenforced evictions, all these bad things that you really don't want in a multifamily property or really any other commercial property for that matter. So if that nightmare deal that I referenced earlier, terrible property management in place. And I've seen another deal that has been struggling a little bit, but they've been able to keep it afloat because they have really good property management. On that particular deal, the sponsor did take out variable interest debt, and of course their debt payments have just shot through the roof over the last 2 years. But they've been able to keep it together because their occupancy is like 94%. And by the way, the break-even occupancy for that property with this current interest rate level is like 93.5%. So the only reason they've been able to hold that together is because they have really good property management. All right, construction risk, which is related to what we just talked about. It's the same premise. Who's doing the renovation work or the construction work? How many properties have they worked on with this sponsor? How long have they worked together? Again, if it's the first time they've worked together, that's high risk. 10th, lower risk. So you see the pattern here. It's the same premise. And again, whether it's in-house construction management or whether it's outsourced is less the point. The more important point is how many deals have they worked on together and how many years have they worked together? How much experience do they have working together? And obviously, the more experience that the sponsor and the construction team have together, the lower the risk in the deal. And you also want to confirm that the sponsor did hire a third-party building inspector for a detailed report. You do not want any surprises when the sponsor actually takes over ownership and possession of the property. Number 4 is market risk. And again, this is it's an umbrella with a lot of related risks. But here are some of the big types of market risk for syndications. 1, cap rates expanding. That is a market risk. It's not something that any of us control. The market moves. We all have seen it happen. Cap rates expand, they contract, compress, and that's part of market movements. Rents rising slower than expected or even falling. That is a market risk in really any type of commercial real estate, including multifamily. Higher vacancy and rent default rates is a market risk. If there were a terrible recession and you had a lot of household bundling where people moved in together to save money, you're going to see higher vacancy rates. And in a recession, you typically see much higher rent default rates. These are all market risks. Expenses rising faster than expected. That's another type of market risk. And that's something we've seen a lot of in the last 2 years, not just on the interest side, but labor costs have risen much faster than projected over the last 2 years. Insurance premiums have risen much faster than projected over the last 2 years. These are all types of market risk. Now, I can hear you. I can hear your thoughts right now saying, but I can't control the market, right? That's okay. You can't control the market, but you can use conservative forecasts when you're looking at these deals, and you want to make sure that the sponsor used conservative numbers in their pro formas. So watch out for things like sponsors who assume that they'll be able to sell the property for the same cap rate that they bought it for. Or same thing, sponsors who assume that rents will rise fast. And, let's call that more than 3% a year. These are dangerous assumptions. A sponsor who assumes 2 to 3% rent growth year over year, that's more conservative. You want to look at the sponsor's sensitivity analysis. You guys are more advanced investors, so you know what a sensitivity analysis looks like. But here's a quick example of one. What would the annualized returns, the IRR, look like under different rent growth scenarios, under different exit cap rates? And you can see under the better case scenarios here, the high rent growth with low exit cap rate looks nice and rosy, right? In the worst case scenario down here with a high exit cap rate and low rent growth, this is what you want to look at. Now, this particular sensitivity analysis is not as conservative as I would like. 2% is not the worst case scenario rent growth. 5.6% exit cap, hardly a worst case scenario, I would argue. But just illustrating a point here. Expense forecasts, the same goes when you look at a sponsor's pro forma and their projections. The same goes for looking at slow or expense growth. You want to see them project high expense growth in the coming years to be conservative. Assuming that expenses are going to rise faster than most people are assuming. Projected insurance, is that based on a real quote that the sponsor has obtained and the actual cost they'll be paying? Likewise with property taxes, is that based on the reassessment amount, the higher amount due to the sale price? And I know every every county and every state handles this a little bit differently. Not all of them reassess immediate or, within that same year or within a year of selling, but these are the kind of things that you want to look out for. Are these types of costs and labor costs, are they projected to grow at a realistic or ideally at a higher rate moving forward than they have been growing? Again, just looking for conservative forecasts in these types of expenses. And I'm curious to hear from you guys. Have you seen your own insurance premiums go up on your homes or any rental properties you guys own? It's something that we've seen across the board among people we talk to. Insurance premiums, no matter where you live in the U.S., they've risen pretty quickly over the last couple of years.
Right. Oh,
yeah.
Did you want us to share about that?
I want to, sure. Happy to keep this
right now in
as a dialogue.
Right now in California, State Farm is petitioning the California government to raise their premiums more than 50%. And that's for homes, like, single family homes, not commercial environments. And the other big East Coast or West Coast problem is dropping of coverage. So State Farm has dropped wildfire coverage in California in certain areas. My parents were affected by this, and they've had to change their insurance, who then had to had other requirements such as changing the roof. So it was a big hassle for them.
Yeah, and there's been a lot of press over the last year or two about some of the largest insurers actually exiting certain states, California and Florida being the biggest and most prominent ones that have been reported on. And some of that, there's I don't remember the exact name of the law in California, but there's some of that is regulatory, where there's restrictions on how much insurance companies are allowed to raise rates. And anyway, that's a whole rabbit hole we don't need to go down. But yeah, it's been a big problem for a lot of people, particularly in some of these states that do experience frequent disasters. So yeah, it's been a problem for homeowners. It's been a problem for investors and for commercial property owners and sponsors. So in that nightmare case study that I referenced at the beginning, insurance premiums doubled within 1 year for those properties. And the repair and maintenance labor costs, like I mentioned, they rose way faster than rents in those for those properties, and that all contributed to that collapse in cash flow and ultimately negative cash flow, and of course the collapse in property value with the sponsor running out of money. You want to look at the cash reserve that the sponsor is keeping for this property. The higher the cash reserve, the greater the protection against running out of money due to pinched cash flow. Now, too much cash reserve, that can dilute returns. So, it's not like there's a magic number that you want to see sponsors keeping as a cash reserve. It depends. The more money that's just going to be sitting on the sidelines, that's going to mean lower returns across the board for the sponsor. It dilutes those returns. So, again, there's no silver bullet for this or magic number, but it's just something to keep in mind as you're looking at risk with these, for these deals. So bottom line here, you can't predict the market, but you can choose deals that will survive market downturns and survive some of these market related risks when things don't go your way. So, hope for the best, of course, but you want to be investing with sponsors who are planning for the worst. If the market has to improve in order for a deal to succeed, then that's speculation. That's not investment. That's speculation. So we want to be investing, not speculating, not gambling. The market should not have to improve in order for these investments to perform well. Quite the opposite, actually. You want these investments to perform pretty well, even if the market goes against you. All right. Regulatory risk is a fifth one. And this is one that not as many people talk about, but it's very real nonetheless. So landlord-tenant laws, they matter in the context of multifamily investments. Obviously they don't for other types of commercial real estate investments, but for multifamily, landlord-tenant laws do matter. I went back when I was a landlord and buying rental properties myself directly. I invested in my hometown of Baltimore, Maryland, which is super tenant friendly, by the way. It took me 11 months to evict a non-paying tenant. And that tenant used every dirty trick in the book to keep prolonging the eviction. And you can do that in markets that are super tenant friendly and have super tenant friendly laws. So you want to look at how tenant friendly versus how owner friendly are the state and local landlord tenant regulations in that market. It doesn't necessarily mean that you can't invest in that city or in that state, but it is a factor to consider. Uh, so in our co-investing club, we typically either will invest in non-residential properties in those markets, or if we are going to invest in a multifamily property in a tenant-friendly jurisdiction, we will only do it if the sponsor has very deep expertise in property management, because that's what it takes to succeed. I've heard the flip side of this argument of regulatory risk is that there's sometimes less competition, and competitors are not willing to bid as much money for multifamily properties in these very heavily regulated markets, and that creates opportunity. But again, if you are going to take on that extra risk, that extra regulatory risk, you should mitigate that with someone who has really deep expertise in property management in that specific market. So here's one example. In our co-investing club, we invested in Southern California, in a property with 11 vacation cabins on it. So these are weekend and weekly rentals. So the landlord tenant laws of California just don't apply to this investment. So we didn't mind investing in a very tenant friendly market because those landlord tenant regulations didn't apply to this investment. And I'll give you another example that I don't think I have here in the slides, but we did invest in a multifamily property outside of Portland, Oregon, which has very tenant-friendly regulations. But the property manager, or the sponsor rather, they started as a property management company like 16 or 17 years ago, and then later became a sponsor. All of their deals are multifamily deals in the Portland area. I mean, they have very deep expertise in that market, so they're able to mitigate that regulatory risk. So here are a couple ways that tenant-friendly markets do add risk to these deals. One is under market rents. If you get bogged down with rent control laws or rent stabilization rules, then you can end up having to rent for less than the cash market rent for those units. Lengthy evictions, like I mentioned a moment earlier with that property of mine in Baltimore. High economic vacancy rates from non-paying tenants, and how long it takes to get them out of the units. High legal fees to remove non-paying tenants or tenants who have otherwise violated the leases. These are just some of the risks that get added. And again, I don't want to get political or get bogged down in that stuff, but there's financial risk that gets added here when you invest in very tenant-friendly markets. And finally, there's concentration risk. So your mother always told you, right? Like, don't put all your eggs in one basket. The same applies here with passive real estate investing, and it's a big challenge given the high minimums. So the way that normal real estate investing looks is, whether someone is buying rental properties themselves or whether they are investing in syndications, you're typically looking at that $50,000 to $100,000 per real estate investment. Again, whether that's down payment, closing costs, cash reserves, initial repairs, or whether that's the minimum investment for a syndication, 50 to 100 grand per investment is a lot of concentration in one investment, and that creates risk in your portfolio because you're not very diversified. Now, that nightmare case study that I've been referencing throughout here, I'd be really upset if I had invested the minimum of $75,000 in that deal all by myself. I invested $5,000 in that, which, don't get me wrong, so I will probably not see that $5,000 again. In that particular case, there was an exit with like a hope note with the buyer, and but I'll probably never see that $5,000 again, and that's a bummer. But that's not as upsetting or ruinous as if I had invested $75,000, right? So the less that you have to invest in each deal, the more you can diversify and spread that money out into different property types, different geographical markets, different sponsors. So imagine that I have $60,000 to invest in real estate in a given year. So I could invest that in one rental property or one syndication. if I'm doing it the traditional way, or if I can invest $5,000 at a time, which I do, I can invest that. I can spread that across 12 different properties or syndications, uh, and that lets you do a form of dollar cost averaging here, where every single month you can be investing in a new real estate investment and just keep plowing forward no matter what the market does, no matter what the press is saying. Just continuing month after month, investing relatively small amounts in different properties, different cities, different property types, different sponsors. So you end up with a lot more real estate investments with smaller amounts per investment, instead of having a couple really big investments that might keep you up at night if one of them goes against you. So, say me in the chat, if you'd rather invest 5 grand than 5 to 10 grand at a time. Would love to hear from you guys. And we're just gonna look at a couple example returns here. This is across 10 different deals. If you invested, and this is IRR. This is not cash on cash, of course. But some of these deals in a given year are going to underperform projections. Some of them are going to be around what was projected by the sponsor, and a couple of them might hit it out of the park and really, overperform for you. But at the end of the year, you're just averaging these as numbers on a page when you can spread small amounts across a lot of different properties. And so you can sleep at night without gnawing your fingernails about how that one property is doing badly when you invested 100 grand in it. So my personal asset allocation looks something like this. Now, I aim to invest 50 to 60% of my asset allocation in stocks and another 40 to 50% in passive real estate investments. I don't want more than 1% of my net worth to be tied up in any one investment. That's an important rule for me. And I can do that because I'm investing 5 grand at a time here. Now, hold up. Don't most syndications require 50 to 100 grand? Sure, if you invest all by yourself, which is why we don't, me personally, or any of the people in our co-investing club. Some people go in on these with friends and family. You can do this on your own. You don't need fancy clubs or anything else. You can form a group of friends and family with similar investing goals. If you have 9 friends or family members, you can go in on a $50,000 minimum investment with each of you putting in 5 grand. All you have to do, create a joint LLC, and then open a joint bank account for that LLC, and then you guys can send one wire from the joint LLC bank account and invest as a single LP, a single limited partner in that deal, and you can hit that $50,000 minimum investment. Or if you don't have 9 friends or family members, this is what we do month in and month out in our co-investing club. We bring in a different sponsor every month, and together we vet their deals as a club. So my co-founder Denny and I, this is what we do. We network with sponsors day in and day out. We're constantly meeting new sponsors, trying to find sponsors who we think are a good fit. So yeah, we bring in a new one every month. Have a group vetting. Every deal, $5,000 minimum. Collectively, we're investing in the $150,000 to $350,000 range. Normally more like $150,000 to $300,000 range each month. But that's the power of doing this collectively. Each person can invest 5 or 10 or whatever they want to invest. So this is how I invest my personal money in real estate, and can keep it, 0.5%, maybe up to 1% of my net worth in any given investment, but no more than that. So our club, we structure this as a flat fee investment club. We don't take any, we don't get a cut of any of the money invested. We're not co-sponsors. It's not a fund of funds. It's just a flat fee investment club is how we structure it. Again, you can create your own little, micro club yourself with friends and family if you prefer. There's no magic to it. Again, you just create a joint venture LLC to invest in these. So I'll give you one quick example of what some of these look like. It's really a deal that we did a month or two back from Post Real Estate Group. You guys are probably familiar with them, just given that they're so big and they've been around for so long. So this was called Bridgepoint. They were assuming fixed interest debt at 3.57%, 5 years remaining on the debt. And they partnered with the local housing authority to get a 50% property tax abatement by setting aside some of the units for affordable housing. It cash flows from day one. So distributions start, I think, within a quarter or two of buying. And that affordable housing component, not only do you get the property tax abatement and improved cash flow from that, but that also protects against market risk. In the event of a recession, what do people do? They flock to more affordable housing. And affordable housing tends to have much lower vacancy rates in a downturn than luxury or mid-range rental units. There is a renovation value add component in that particular deal as well, in addition to the tax move. And this posts, one of the things that I like about them, by way of example, so they have in-house property management and they have in-house construction that they've done dozens of deals with. This is not their first rodeo working together like we talked about earlier. So again, this is just one example of a recent deal that we looked at. And if you're thinking about creating your own little club to invest in these together, check out Post because they've done like 130 deals over the course of like the last 20 years. So they've been around for a long time and have a long track record. So
hey Brian, how do you spell that? Are you saying P post or H host?
P post,
Okay.
like a fence post.
Okay.
So I cut my teeth in real estate with rental properties and in particular BRRRR deals. So I owned around 20 properties as a landlord. I hated being a landlord. So today I don't own any properties directly anymore. I do have a fractional interest in somewhere in the 2,500 to 3,000 units range at this point. And I wanted to end, we spent the whole conversation today talking about risks. And I wanted to end on a slightly more positive note here that many of the risks that landlords face and direct real estate investors face when they buy properties directly, many of those risks don't apply to passive real estate investments. And I'll give you a couple examples. One is legal liability. So when I was a landlord, I got sued several times. And it sucked. I got named personally in both suits, despite the fact that I owned those properties under LLC names. One of them, the neighbor was claiming that my roofer messed up their roof. Another was a seller leaseback deal where the seller defaulted on their rents, but they still wanted to buy the property at the discounted price. And it's just stupid stuff. And I won both of those suits, but it's not fun being sued. Even if you win, you still go through a lot of headaches and legal costs and sleepless nights. So that is one type of risk that does not apply to real estate syndications or passive real estate investments. You cannot be sued as a passive real estate investor. Evictions and legal, having to mess around with serving state-specific eviction warnings and waiting the prescribed number of days and filing in rent court and showing up for hearings, missing your work, your day job to go show up at rent court hearings, scheduling the put-out date and showing up with the sheriff and locksmiths to change the locks and clean out all the abandoned junk and so forth. You don't have to deal with any of that stuff as a passive real estate investor. Loan liability. When you buy properties directly and you take out a mortgage loan or a hard money loan or a portfolio loan or whatever it is, you have to sign a personal guarantee. So if you default on those investment property loans, the lender can come after your personal assets, your personal home or your car or your stamp collection or whatever it is. That is a risk that you don't take as a passive real estate investor. Lost personal time. So, like I said, I owned around 20 properties, over the decades, and there was always something going wrong with those properties or going on. So my vacations got interrupted, my weekends, my evenings. I've had tenants show up at my house before. I tell this story about how I was on my third or fourth date with the woman who is now my wife. But I cooked her dinner at my place, and we were watching a movie on the couch. And at like 9 o'clock at night, there's this boom, 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 boom on the door, and it was a tenant with his translator cousin who was coming to. Anyway, that's not the kind of stuff that you want, right? And that's not a risk that you take when you invest passively. You also don't have the same tax complications when you invest passively. You don't have the risk of incorrect tax returns. When you invest actively, you got to track all the income expenses yourself, the bookkeeping and the accounting. And you have to report all of it perfectly accurately on your Schedule E in your tax return. With passive investing, you just get a K1 or maybe a 1099 interest if you're earning interest on fixed interest or debt investments. So you don't have to worry about any of those risks as a passive investor. Again, this is how I personally invest. I try to invest relatively small amounts in a lot of different deals. My goal with my real estate is to earn twice the returns that I earn on my stock investments with half the risk, and that's a bold goal, but I think I can achieve it. And it starts with checking these 6 risks when you're looking at real estate syndications. So, invest with other people to reduce some of those risks, and vet deals with other investors, whether that's other people in this club, whether that's other people in a friends and family club that you create yourself, whether you end up investing alongside us in our co-investing club. It really helps to vet deals with other experienced investors, so you get dozens of eyeballs all looking at the deal from different angles. And it helps to invest small amounts, so you can diversify across markets, property types, sponsors, etc., and avoid these losing investments, the ones that actually lose money for you. Now, yeah, this is not for everybody. If you guys are interested, please come check out our oh, that's actually this is not updated for this this presentation, but we have a full no questions asked refund policy if you decide that our club is something you want to try out. So no questions asked. We refund everybody. So parting thought: invest with a fellowship of other investors, whether it's something that you create yourself, or whether it's through a club like AIC or through our co-investing club. Join a fellowship of other investors. It'll make your life a lot easier and lower your risk. So on that note, actually, you know what? I take that back. We did set aside the free trial for this group, and that's the link. So anyway, that's all I got.
All right.
Let's have an open conversation.
So when that fellowship started, somebody asked, "Where are we going?" And that's perfectly okay to ask with these types of investments, of course.
Where we're going is the finish line of financial independence. With the
right.
Yeah.
Thankfully, it's not to Mordor.
Not to Mordor. No. We're going good places.
All right, we got a number of questions here. Let me
Awesome.
start more towards the top. So this might be jumping back towards some of the beginning of your talk.
Yeah.
And I just lost it. Where'd it go? Basically, it was a question on: do you prefer your projections in the expense categories to be as expected, or do you prefer aggressive expense increases when you're doing and looking at underwriting?
So I want to see sponsors be very conservative with their projections. So modest projected rent increases and relatively high projected expense increases, because I want to be pleasantly surprised by the returns when they hopefully beat the projections, rather than being, unhappily surprised when the market doesn't go our way, when it doesn't go in the way of the sponsor. Like we touched on with the whole market risk conversation, you can't control the market, but you can plan for the worst. I want to invest in deals that even if the market turns against us, the deal will still be okay and it'll still deliver positive returns, even if those returns aren't quite as high as I was hoping they'd be. So that's what I look for when I'm looking at performer projections.
All right, and we've got 7 minutes left and probably 7 questions, so I'm just going to fire them at you. Ashish is asking, how do you consider complexity and increasing CPA costs from having 12x the number of K1s?
So
I'm going to follow up with how do you keep your expenses down when you're accepting 5K, amounts as well?
Yeah, no, great question. And that's actually one of the first questions that we usually get. So what we do is we have a CPA who, so the joint LLC for each one of these deals, every participating member gets listed proportionately as an owner of the LLC, proportionate to what they invest. We have a CPA firm who Once the LLC gets the K1 from the sponsor, CPA will go in and calculate out each individual member's personal K1, and we send those out. The way that we pay for that is each person in the LLC pays a flat $75 a year fee for accounting and administrative costs. And so some people will object, oh, well, doesn't that dilute your returns a little bit? Doesn't that reduce your net returns? Yes, of course it does. That's the cost that you pay for investing $5,000 at a time in these real estate deals instead of the 50 or 100 grand that you would have to invest if you invested by yourself.
Well, and anytime you invest in a group investment, the group has to pay those expenses. Every investment out there has to file their taxes, so
Exactly.
it's a baked in expense basically. And
Yeah.
$75 per year is quite low. That's a great price point.
Yeah. And some of that's
You have
because
an
we were,
accountant in Peru doing that, or how do you do
no,
that?
no. It's a U.S. accounting firm.
Okay,
But because we've got several dozens of these LLCs, we just negotiated a bulk
gotcha.
discount on
Okay,
these. So
okay.
yeah, so each LLC is paying a relatively low amount
I think
in
this
accounting
person
fees.
might be asking a similar question here. Glenn is asking, Brian, do you see operators who commonly accept 5K, or are you through a fund as a way to solve? And for accredited, is this for both accredited and unaccredited investors or non-accredited?
Okay. So that's really important. One of our core values is inclusivity. We only look at investments that allow non-accredited investors. Now, at some point in the future, we do want to open like a sub club for accredited only. But for right now, so we meet every month. We look at a different deal. Every deal allows non-accredited investors. Now, your other question. So we are not a fund of funds. What we do is we create a new LLC for each deal that we invest in collectively as a club. Anyone who wants to participate in that deal, they get listed as an owner in that LLC.
All right. Ashish is asking, what are your thoughts on companies like Lofty AI, which allow even smaller investments?
Yeah. So I I have not invested personally with Lofty. I have invested with two of their biggest competitors, Arc 7 and Arrived. And I have a little bit of money invested with each of them in single family rentals. Fractional ownership of single family rentals through those two crowdfunding platforms. Um, they're fine for what they are. I don't expect, and I'm not seeing or earning particularly high returns. I probably expect a combined return around 8% a year from those, roughly 4% distribution income and roughly 4% appreciation. Um, so it's fine. It's a good way to diversify and spread really, really small amounts across a lot of different properties. Um, I don't in our co-investing club, we're looking for higher returns than that. Um, and we're doing different types of investments rather than just single family rentals or small multifamily rentals. We look at everything from debt investments to obviously real estate syndications, like we talked about today. And every different property type, from retail to industrial, multifamily, mobile home parks, storage. We've invested, vacation rentals. We've done everything. And including some private partnerships with people who are not sponsors. So it's different. I'll wrap up by saying Lofty AI, one of the drawbacks of them is that when you sell your shares, so they have the nifty secondary market for selling shares, but you get paid out in a cryptocurrency, not in US dollars. And then it's on you to convert the cryptocurrency back into US dollars, which not everyone is comfortable with. So anyway, I'll leave that one there.
All right, we have another question asking, who is your CPA or legal representation? Somebody wants to get a better deal on theirs.
Yeah, yeah. So the one partner's name is Robbie Nelson. I can't remember the name of their firm, but if you send me an email, I'd be happy to send you a link to their website or introduce you. The other partner's name is Glenn, but I can't remember his last name. But anyway, yeah, if you shoot me an email, Brian@sparkrental.com, I'd be happy to connect you with our CPA firm.
Is it Stericycle? I found
Stericycle.
this guy. I found a tax person with that name on LinkedIn. Okay.
No.
All right, we've got just 1 minute left. Quite a few number of questions here. Let's go to Ramesh. How do you do these vetting? How do you vet if you invest in a fund without prior knowledge of the future assets it will acquire?
Oh, so we've never invested in a blind fund. Most blind funds, we have found them to be mostly 506C investments that are only open to accredited investors. We've never invested in a blind fund. We only invest in it's when it's syndications, it's mostly single property syndication deals. So we know the property. Occasionally, it's a portfolio of multiple properties. Like we invested in a portfolio of 4 mobile home parks one point last year, but they were all known parks. So yeah, short answer, we don't. We've never invested in a blind fund.
And then last question, and this ties into that, is when you have so many LLCs, just logistically, how do you handle that?
That's that's a great question. So my co-founder, my partner Denny Sipli, she handles more of the operations side of the business, and she and I have had a lot of conversations this year about her pulling her hair out about just how much more administrative work there has been than she thought there would be when we have dozens of these LLCs. It's really been a source of struggle for her. We hired a new team member just about a month ago, actually, and we've been spending a lot of this year focusing on putting in predictable or structures in our business, structured processes for every single part of this. So it's not just dependent on my co-founder doing most of the administrative work herself, because it was getting me too much. So automation, delegation, being very organized and structured in all of our administration of these LLCs.
All right. Could we have everybody here at the Alternative Investing Club take themselves off of mute and thank Brian for coming in and speaking to us today?
Thanks,
Thank
Brian.
you.
Hey, thanks, Brian.
Thank you, Ryan.
Thanks, Brian.
Thank you.
Thank you,
Yeah,
guys.
thank you, Brian.
That's such a nice touch. I love that, Daniel.
It's always great to hear from the people that you're talking to. They're not just out there in the ether. So
that's a great touch.
Everybody have a wonderful weekend, and we'll see you back here next week.
Thanks again, guys.
Thank you all.